My name is Stan. It's a program full of contrast. We have seen really exciting developments in other countries. The good news here is Germany is very stable at the moment. The big question mark is what happens maybe in 5 years. Yeah? So at the moment, very, very stable. And I'll try to give you an outlook as well. So I'm in charge in our firm for the international tax practice. I'm doing it for more than 20 years. Covering the whole world, and Germany is well known for its export business, but today I'm just focusing on the tiny little parts you have to keep in mind if you're doing business in Germany. So it's more of an inbound view, because I think it's the more interesting probably for you. I'll do it the German way, so there's the agenda. 4 topics only, very, very simple. Short word who we are. I'll explain you why we call our tax environment stable at the moment. I'll give you a checklist of what to pay attention to if you are an investor into Germany. You can use it as a kind of checklist, and if you tick everything off, you are fine. No bad surprises. If you don't tick it off, you rather do something about it. And I'll give you an outlook, and that's a trial to give you an idea of what might come next. Okay, who we are? We are number 7 in Germany. It's not a small firm, more than 1,500 employees, and we cover whole Germany. We reached, or we are going to reach this year, the 200 million euro revenue, which is about 300 million Canadian dollars. So we are not small. And our clients are mainly what you know as the hidden champions. So if you buy something and there's a German manufacturer behind, it is usually our client. So our clients have subsidiaries all over the world. And at the same time, we are servicing clients from outside. Yeah? Therefore, we are part of the Nexia network. So we get a lot of referrals by Zeifmans when we take care regarding the German part of that business. We are growing. It's part of our business. Yeah? There is a bigger challenge to get talented staff in. It's not so much about the work itself. Yeah? There's so much work around in the tax environment. But I spoke with the colleagues. It looks like everywhere the same challenge here. When we look at Germany, you probably know this map. We are really covering whole Germany, which is pretty important in Germany, because we have a capital, Berlin, but it's not the business capital. Frankly speaking, we don't have a capital of business. Yeah, so we have Munich, which is very strong regarding software, pharmaceuticals industry. We have Stuttgart, the region I'm in, this corner, which we call the automotive capital. Yeah, it's Porsche, it's Daimler, all the big players are there. We have more to the west, Düsseldorf, we have in the north, Hamburg. Each region is strong in particular areas, so you really have to be there. It's not that it's sufficient to be in one city. If you want to service it properly, you have to be in the region. It makes a difference to a few other countries, and you need to know that if you deal with Germany. What we are doing is a multidisciplinary approach, but I'm going to talk about the yellow part, the tax consultancy today only. And when we look at the tax environment, I call it stable. I call it stable because we don't have any major tax reform ahead at the moment. The last reforms were introduced are already pretty old. It sounds like good news. In reality, it's not good news, because Germany was considered to be the pilot country within all these developments. So most of the topics we were talking today, what the US was introducing, what you see in other countries happening, it all happened already in Germany. Yeah? So within the OECD, which took a very strong lead in attacking aggressive tax planning, Germany was considered to be the country to give it a trial. So we have all these bloody rules regarding BEPS erosion we heard about in the US, regarding the FinCap rules, the CFC rules. We have it already in place. And authorities are educated about it. Yeah, it's not that we have something new there, but we are already in a phase where the authorities really go behind the taxpayers. Might sound a bit aggressive. On the other side, it's good news because there's not much uncertainty left anymore. Yeah, so you know what you're talking about. You can make your heads about it, and if you behave accordingly, which doesn't mean you have to spend all the money to the tax authorities. You should just avoid to be aggressive about it. Then you know you can predict your return on investment pretty easily. That is really a good news at the moment. So that is what I call the major focus was on tackling international tax fraud. So we are familiar with all these rules, and what we see is introduced in all these other countries, France, Italy, Turkey, even the UK with Brexit ahead. They are all looking at the German rules. Yeah? So often we find copies of the German rules there, and that makes it predictable. Let's call it this way. Of course, there's an exchange of information going on. So if you do something in Germany, you can be sure that the German authorities talk to the Canadian authorities. Yeah? There isn't any hidden secret or something like that anymore. It's jumping, kind of. When we look at the tax sides, it's sure we are not a tax haven. Yeah? We have a corporate tax rate. It's a combination with trade tax, but at the end of the day, you pay about 30%. It's a high number on one hand side. On the other side, everything which is related to business you can deduct. Yeah? So when you compare the tax basis, it is a friendly country. The rate itself is not friendly at all. And I'll give you an idea about what might happen next. On the other side, we have other taxes which business has to give a thought about. It is mainly about the indirect tax. It is here known as HST tax, or in India it's a GST. We call it the VAT. At the end of the day, it's the same thing. You will see later on from the checklist what you should pay attention to. There's a lot going on into the real estate business. Germany is still considered to be a cheap country. I wouldn't call it cheap anymore. Yeah, so the prices for real estate went up significantly, but still the British tell us it's cheap, and some other countries. So there's a lot of money flowing into the real estate industry, and everyone cares about the real estate transfer tax. So when you pass on real estate, and here you see the impact of the financial crisis. So it was always 3.5% of what you were moving, and we are now at a rate of 6.5 in the highest region. So you see the authority goes where the money is here. There's no general property tax, which is good news. On the other side, the authorities don't know anymore what is really going on regarding property. But they figure out once you inherit it, you give it, you pass it on. So there's an inheritance tax, there's a gift tax. There are quite a lot of changes in that area, but the good news again for business, it's not impacted that significantly because there are so many exemptions for handing over business that at the end of the day you don't pay that much taxes in that area. Of course, taxes is not everything. I think it is quite similar to Canada. You have to care about social security taxes, however you call it. It is money you have to give to a state. And Germany is not cheap in that respect. Nevertheless, the labor costs are not impacted that significantly because there are caps built in, which makes Germany quite employment friendly. Yeah? The rates itself look quite high, but because of the caps, it's not an expensive country in that respect. When you do tax planning in Germany, you have to keep in mind that the authorities, I mentioned it in the beginning, are experienced. And they are experienced because Germany is known for its tax literature for 100 years, yeah? And the authorities are well trained. They are not well staffed. There's shortage in staff as well. But once we are going out, they know what we are going to do. And I don't want to go through all the details because you get these presentations. You can use it as a kind of checklist. I'll just highlight 2 topics. So if you start a new business in Germany, the first thing you have to care about is whether your place of effective management is really in Germany. So often we see investors having a US guy as a managing director or a Canadian guy. And if this person is visiting Germany twice a year, you have created a double taxpayer. Because according to international tax rules, of course you are a taxpayer in Germany because the company is located in Germany, but you are a taxpayer in your country as well, because the US as well as Canada have the same rule. It matters where the place of effective management is. And if this guy is coming into Germany only twice a year, the authorities will reject and they won't accept that the place of effective management is in Germany. So you are immediately not in trouble, but you make it already complicated. So the advice here is pretty simple. Either you appoint someone who is frequent in Germany, ideally lives there. It doesn't have to be a German. Yeah? It can be an Indian guy, it can be a Chinese guy, whatever. But it should be a person who lives in Germany, yeah? Just to avoid this complexity you built in. And that is what the authorities check. Yeah? Because you fill in the address, and if the address is abroad, they immediately send you a questionnaire and you have to answer 50 questions. And the same happens at the indirect tax side. Yeah? So if the place is not in Germany, it might be that you don't get a VAT registration number, and if you don't have it, you can't do business. So it delays the process. These are little tiny things. If you are aware about it, you can avoid it and go ahead with it simply. The biggest issue when you do business, everything is stable, is transfer pricing. It's not a surprise. Yeah? There are no special transfer pricing rules in Germany. It's all international rules. So if you know the Canadian ones, you know 95% of the German ones. The message is take care of it. Yeah? Don't ignore it. If you take care of it properly, then you are fine. What happens next? That's the question I promised you to give you an insight about. Yeah? Everything is stable. It will be stable the next 2 years for sure. But I'm not sure whether everything will be stable the next 5 years. Because you have seen how the corporate tax rates decrease everywhere. The German answer at the moment is we are not going to change the German tax rate. But I'm not sure whether we are able to stick to that. Yeah? So the US is significantly down. The UK will go significantly down. So there's a race to the bottom at the moment. Therefore, my prediction here is that the German rates will go down as well. Probably not that significant. But there will be a downside because the state authorities need money. So what is going to happen is that there will be an increase on other taxes, likely the indirect taxes. Not sure about the inheritance and gift tax, but it will be impacted probably by the indirect tax, which is good for business because if you structure the indirect taxes properly, it's not a cost for business. If you ignore the indirect tax compliance, it will hit the business significantly. Yeah? It would be a real surprise if there would be a call for a significant decrease of the tax rate. It's unlikely to happen, regardless who will win the next election, yeah? Because there is a kind of understanding that Germany is a high, properly well-staffed country, so it won't be a tax haven, never. What we expect are a few technical updates. The most interesting one is mainly for German investors, not for foreign investors, because we have strange CFC rules. But as an investor from outside, you are not impacted by that. These are structures where you build on subsidiaries under the German one. Yeah? But if you just do an investment, all these reforms which are ahead won't impact you. So from your perspective, Germany will remain tax-wise stable. When you read the newspaper, and that's the last comment, before I'll hand over back to Stephen. They started a discussion regarding taxation of utilization of personal data. Yeah, so whenever you use Facebook, Google, or whatever, you pay with your personal data. And I'm not sure whether Germany will still be a pilot as it was regarding tackling all this tax fraud. But Germany will be one of the front runners regarding this. So I'm expecting more changes into that area. Our Chancellor announced to tackle that area, but it doesn't give a clear picture at the moment. Yeah? So nobody can say how taxation of utilizing personal data will look like. Yeah, it's far too early, but pretty sure we will see something happening in the next 2-3 years here in that area. So Germany is prepared for taking a kind of lead, probably not a pilot position here. How this affects business, I don't know. Yeah, probably Facebook, Google will be hit. On the other side, we will find ways to do something about that. That was a little insight into what's going on into Germany. Any questions?
Is that 30% a flat tax rate? You find if they're bigger, large corp, small corp, or is it a tier system?
I would call it a flat tax rate because it doesn't differentiate between small and big business. It's not a flat one because it has two components. The corporate tax is 15%, and there's a trade tax, and the trade tax varies according to the region you are in. So in reality, it's 29 point something up to 31 something. Yeah. So no, but for planning purposes, you can call it a flat tax.
So there's no breaks for a smaller business with less capital?
No.
Is that something that maybe they move to if they're worried about it, a two-tier system?
Unlikely. The German tax system is already pretty complex because of partnerships taxation. But when we speak about corporations, and 95% of all the inbound investors go for corporations, you use 30% and you are fine for planning purposes. Yeah.
Did I hear you say that there's no property tax in Germany?
Yeah.
And that's on commercial as well as residential properties?
Yeah.
Do you believe that there's any indication that on specifically commercial properties that the German tax authorities will want to start taxing, especially, let's say, real estate investment trusts that own a multitude of commercial, industrial, properties?
No, I would call it's unlikely, and I'm pretty sure about it because there was a heavy discussion about that 10 to 15 years ago, and the result was we don't find a constitutional way to tax property properly, and therefore nobody touches that area anymore. Of course, nobody knows how the next election will go, and if there's what we call the right wing, we might come up with some crazy ideas. Yeah? But when you look at it from a more constitutional perspective, all the open questions have been answered in the last years, and the constitutional answer was, don't do it. Don't do it. Therefore, it's rather unlikely. They tackle on selling companies, selling property. Yeah, so capital gains, yes, but purely having property, no.
In relation to Google taxation, the European outcome on revenue taxation of technological company, do you see any problem with the constitutional validity of this tax? You're being taxed just on the revenue and not on the actual profit.
Yeah, of course. The German system is very clear. We can tax the profit only. Yeah, so it's not about the revenue.
Yeah. So you will the only country in Europe that won't have that kind of tax.
Might be, yeah. Because the law is very clear. So
yeah,
we have.
You can change constitution.
Yeah.
No, but then you have a VAT, which is on.
The focus is really more on the indirect taxes, which doesn't impact the business. Yeah. It impacts the consumers.
Are you saying that in Canada, in every province in Canada, if you own a house, you're going to be paying realty taxes to the municipality for sewers, for water, for all
yeah,
services.
yeah. Of course,
So
you
if I
pay.
say-
No, we pay these kind of let's call it excise duties or however you call it.
Well, no, these are just realty taxes levied by the municipality. And
Yeah.
it's usually on an average house, it's $5,000 to $10,000 a year.
Yeah, we have something like that as well.
Oh, you do?
Yeah.
You have local taxes.
Yeah.
Okay, those are local taxes.
Yeah, yeah. But business-wise, no, they don't play any role. As a private person, of course, you
So,
feed
so
your
really
money.
you're referring to what we used to have here
Yeah.
called a capital tax.
Yeah.
Estate
Yeah,
tax. Estate tax.
We call it estate tax.
Yeah.
Of course, it might be that this goes up a bit. Yeah, there is discussion regarding that, but again, it doesn't impact business. It impacts you as a private owner of a house, but the impact again will be little. Yeah, nothing really to worry about.
You also mentioned a subsidiary. If a Canadian company incorporates a subsidiary in Germany, if an executive from Canada goes over twice a year,
Mhm.
that constitutes management, care and control in Canada?
According
So-
to the international tax rules, yes.
So that 2 times a year?
It's not sufficient to have the place of effective management of a German subsidiary in Germany, and that, according to the German view, divides this company into a German PE and into a Canadian PE.
But presume that this company that you set up, especially in the initial years,
Mhm.
the Canadian parent wants to send somebody over there to see what's going on, even if its office is in Germany,
Mhm.
and it has a nominal president of the company who's a German. But if the chairman or someone who has authority over that company
Mhm.
goes over twice a year, then it's deemed to be care and control in Canada.
It depends on who is really running the daily operations.
So
of
if
course,
it-
in this example, you would write a letter saying to the German guy, "You run the daily business, and I'm there just to supervise." But when you start the business, often the investors make the mistake; they appoint one person only. Of course, it's a home guy, and then you are immediately into that trap. It doesn't cost you at the end of the day more, but the
So it's not a
complexity
matter
of dealing.
It's
is-
not a matter of 2 visits a year, but rather it's a matter of it's a question of fact as
Yeah.
to who is in
Who's
charge.
Yeah, exactly. Yeah. So our recommendation is either you appoint someone who lives in Germany, or if you don't want to do that, you have a second level of management, and the guy you mentioned writes a letter saying, "I hand over to you the daily operation tasks." Yeah. But these are the little tiny things which you really have to argue then with the tax authorities about.
So with the deal of German companies having holding companies in Luxembourg, something like that, which they visit once a year to get the board meeting or something like that, you assume that it's got to be in Germany since they actually live there, or how do you work?
That is one of the big question marks at the moment. Yeah. So the tax authorities really look at how you would call it the board members, and if you are unlucky, you have, let's say, 3 guys in 3 different countries, and that means, from a German tax point of view, you have 3 permanent establishments. It's the same if you have a Luxembourg company and there's someone sitting in the board and lives in Germany, it makes the Luxembourg company a taxpayer in Germany. But it's not a German attitude, it's an international rule. But because the authorities are educated, they go after that.
Yeah, I've seen
Yeah.
that.
Well, thanks, Dan, and Kubal for the wonderful presentation.